going over what's happening on Yahoo Finance. Today, let's go and see and see. Okay, so wonder why it doesn't show me. Okay, well, let's look at the S&P 500 right now. Okay, right now we're basically super overbought. we're just we just got through a holiday week, and we're up for the week, and we thought it would be because of the holiday. As you can see in this upward channel in the S&P, we're at the top end of the range. We're overbought. The VIX is down. It's all indication that as a contrary investor, you don't buy now, and you basically hold and don't buy. But we do know there's indications that at the end of the year we have a Christmas rally. It's a Santa rally. Actually, a Santa rally isn't the week before Christmas. It's the week after Christmas. So between Christmas and New Year's. So now that we're overbought, we're looking at our calendar. I'm thinking we're going to be probably going down for like a week or two, because we do have the FOMC meeting where the Fed decides the next interest rates. That's in December 13th. So that's a big day. There's a lot of caution before then. So that's a good reason more than any for the stock market to go down. We actually have 2-year and the 10-year going up today. So that's another reason for the stock market to go down. So that's the big picture. We expect like a Santa rally towards the end of the year. We have New Year's and Christmas, and we have another holiday coming up in middle of January. So we have 3 holidays in a short amount of time. So that stocks usually go up around then. But we do have a recession, according to Jeffrey Gundlach. I trust him. There's all kinds of signs pointing towards a recession. And in general, when there is a recession, stocks usually go down. And there's no way around that, I guess. So I'm expecting February to be a bad month. It's historically a bad month, seasonality-wise. And on top of that, we have indication that there's going to be a recession. So for me, a long-term investor, I'm just not buying, and I'm holding. If there is a recession, I'm holding through that. And we should be out of a recession around April or May, and people are feeling better. The weather's better in the East Coast, where most of the trading's going on, and we're coming out of a dark time of winter. So, you have to, like, as a long-term investor, you got to be willing to hold your stocks through a recession in bad times. Okay, so let's look. Okay, let's see if we have everything populating now. That's Europe. Wait, where's U.S.? Oh, I know why. I connected to the Singapore VPN, and everything is Asia. So this is okay. Everything's flat today. We don't have a lot of activity one way or another. So we're overbought. We know that. So if we were to guess if it's going to go up or down, it's going to go down because it's overbought right now. So let's see what's going on in the news. Okay. There's a little note that NVIDIA has news today that they're going to delay a chip for Asia. There's some sanctions or some rules that NVIDIA has to follow where they can't export a certain amount of chips. And 25% of their sales are to China and to I think are to China. So now if they are limited to what they can sell to China, their growth is really, really limited. But they did say they can find other people to sell things to, but they're trying to design a chip that can be bought by the Chinese. So that's, but that's still, they're still going to have really good growth, regardless of whether they can sell in China. All right, so let's look at, sometimes you got to look at news articles and say, well, does that have a real big effect on the stock or not? And during a conference call, this Jensen Huang said they can find other people to sell their chips to and make up for that. And meanwhile, they're trying to engineer a chip that they can sell. Let's look at some of our stochastics on our stocks. Okay, we got the S&P. We're definitely at the top end of our range. It's a very predictable uptrend. We have been overbought for several weeks now. We finally got to the top of this channel. Because of that, I expect to go down, and I'm thinking the next step is down here. And then we go up here for the Christmas rally. So, and look at this, the MACD, the RSI, everything is peaking with these stochastics. Let's look at some of the other indices. So we have the QQQ at the top of its channel, and it's been overbought for a week, couple weeks. So all indications are we're going to be going down. And same thing with the aerospace. We have gold. Almost every chart we're overbought. You can see we're overbought, and we're not peaking in materials yet, but it's still overbought. Communication sector. So right now we have a lot of people that are excited about the stock market. They're greedy, and that's you have to invest as a contrary investor. Like, this is the time you would sell covered calls. You would all these people that are trying to get in at the last second. There's a lot of people that are a lot of fund managers that are window dressing. That's buying the winners, and there's a lot of tax loss harvesting now. That's the losers of the year. People try to sell that to take offset some gains. So I expect between now and the end of the year, a lot of the losers go down more because people want to sell them to make room in their portfolio. And we see healthcare, it's overbought. Every sector, look at this right here, it's overbought. XLI, financials, consumer staples. Okay. Right, so we have every sector overbought, and everyone's excited and greedy right now. So let's look at our meeting notes. We have a 1%, the treasuries went up 1% from last week. So we have a contrary indicator here with our treasuries. Look at this. We have the 2-year treasury, 10-year treasury. 10-year treasury is actually more important. You can see as that is going down, the stock market is going up. But you can see right here that it's starting to go up now. So as that 2-year treasury goes up, the stock market will go down. That's what it seems. It's the same thing with the 2-year. So you can see that we have that spot right here in all of our stochastics charts. We're at the top of that range. We're at the top of our stochastics, and that's matching up with, a low in the treasuries, and it's starting to go up. So that's all an indication that we're going to go down for next week or so. But that'll be for a couple weeks, and then we'll go up for the rest of the year. Okay, let's look at some other things to think about. This is the best time of the year. So regardless, if we're overbought or oversold, it's a good time of the year to be invested, to be fully invested. We're starting to have market breadth come back into market. Last couple of weeks, we see the number of stocks above the 50-day moving average going up. Like, it went up 10%, 8% in the last week. So now 74% are over the 50-day moving average, and 48% are above 52% now are above the 200-day moving average. So that's an indication of momentum. And there's a fear of missing out. And when people are greedy, and that gets people to buy stocks. We have corporate buybacks the last month of the year, and inflation is getting better all the way around. But the U.S. dollar has been going down, and that's another good thing for the stock market, because a lot of stocks depend on the dollar when they're repatriating money from overseas. All right, so now the companies we're focusing on now are the ones that don't need to borrow money, have little or no debt, and are still growing. And the ones that are of zero growth, we're trying to avoid at all costs. And ones that are losing money, we don't even look at. Okay, so we're in November. We're going into December, 2 best months of the year. So we're going to be overbought and probably going down for 2 weeks. But overall, and you add it all up, it's going to be probably a good bet for the rest of the year. It's going to be decent. Okay, now, all right, so we already talked about the S&P and the 2-year. And oil is down a lot from the beginning of the year. It's and that's most likely because of a global recession. That probably the less demand for oil. If there's less factories going, less machinery going, building things around the world, the less oil is needed. So that price of oil goes down because of that. Also, there's a meeting of OPEC that was delayed for a week. So they're whenever the oil gets down to $60 or $70 a barrel, there are meetings, and they try to get the price to go up by cutting production. So the price of oil will probably go up next week because there's going to be an OPEC meeting, and they're going to say we're going to cut production, and that affects inflation, because if oil is $100 a barrel again, then inflation starts going up, and that's the biggest input cost for any business, every business. So let me see. Dollar index is going down. So there's let's look at the dollar index. You can see it was going up for most of the year, but in the time, the one correlation to the stock market going up to the dollar going down. So we look for little hints when you're an investor of, will stocks be going up or down in the future? And when the dollar index is going down, that's a hint. That's like a 1% hint that stocks are going to be doing good. Fear greed index is greed. We've been having fear for the last at least month and a half, and we were at neutral last week, and now we're at greed. So when we get to the end of the year, we expected there to be a lot of people trying to catch up. A lot of fund managers, if you haven't owned the big tech stocks so far this year, you're going to look really bad. So there's a lot of people chasing those big 7 tech stocks. Then they're getting rid of all the stocks from their portfolios that have done really bad. So they don't have that in their top 10 holdings for their mutual funds. Where were we here? Okay, so we're at greed. So we're gradually going towards extreme greed. But I don't know how far we can go. This is probably as far as it's going to get. Then we're going to start going down again. So that's another indication you don't want to buy right now. This is the time everyone piles on. And this is the time you will either want to sell or sell covered calls, so that you can, it's called feeding the ducks. Whenever, people are chasing the stocks going up, you give the ducks some food, and then whenever the ducks eat the food, all the stocks drop, and then you live for another day as a trader, they say. So for me, I'm just not buying right now. It's kind of, I'm already invested. Whenever the stock market was down and we were oversold, that would be the time to get fully invested if you're interested, but not now. All right, so, okay, the VIX is at a low. So we're making another contrary indicator. When the VIX is low and people are greedy, that's the time that a news story comes out and people are afraid again and they get fearful. So another contrary indicator that the stock market's peaking. We're at the greed part of our emotional indicator. So we have the takeoff, first off, media attention. We got media attention now like crazy. The people on TV are hyping stocks. We can't believe it keeps going up. And then we're going to have some kind of news story soon, like maybe some treasuries auctions don't go well or something like that. Then we'll start getting the fear in probably the next 2 weeks. We haven't had capitulation in a really long time. A lot of these major issues that could have caused a crash, they're kind of resolving themselves one at a time. Like the treasury rates are going down, so they're not as big a problem as we thought. The consumer debt is still a problem. High gas prices? No, they're going down every day. We can see it. And a lot of people are just okay with stocks being overpriced. We're going to go over some stocks later on today, like Apple. They're 3 times overvalued, but everyone in the market is okay with that, and it's not a big deal. That could be, if the big 7 stocks normalized to 15 times earning, like the market usually is, there would be like a crash in the market. But it seems like people are complacent with profitable companies. And right now, this environment favors profitable companies that are predictable. And you pay a little bit more for that. And right now, there's not a whole lot of companies that are profitable. Most companies aren't profitable, I think. But that's why people pay a little bit more for the better companies. All right, let's look at some. We always like to look at this one. This is the S&P. This would be so important right now. We're at 15. I just checked it right now. We're at 20 times earnings. PE ratio is 20 in the S&P. Average for this for 5% yielding Treasury is 15. So we have to realize that all times we're overvalued right now, and at any point in time we could correct to this 15 PE multiple for the stock market. So I'm ready for that. I'm going to review this article again, Jim Cramer. This isn't Jim Cramer's article. Some guy on the internet kind of follows Jim Cramer. And I'm going to go over some of these stocks that Jim Cramer chose for his charitable trust. And I'm going to see what, the statistics around them and why he chose them. First one we're going to go over is NVIDIA. The interesting thing about NVIDIA is it's growing like an amazing amount. Look at this. There's no stock that in the stock market that's this big of a company that's growing that much. It's 360% from this year to next year. That is a pretty amazing amount. But the interesting thing about the forward years, we have 40%, 15%, and 1%. And the reason why I think these numbers for the outgoing years are suspect is they didn't predict this year correct. How are they going to predict the next year's? So I just think for a stock that's growing 360% year over year for this year to next year, and it only has a forward PE of 25, that's it's almost half off if you make it like only 50% earnings growth. So the problem is that these accurate or not, and that you can't. You have to take it with a grain of salt, so you don't know. But you have to trust in the analysts and hope they're on top of things. So the investing thesis, the reason Jim Cramer likes it is that the CEO Jensen Huang is like a visionary. He's creating new products and new fields. AI he was starting a long time ago, and now it's all coming to fruition. He has all kind of new visionary products that he's starting. He had some metaverse ideas, and he actually has robots in a metaverse, and so he's a visionary. So it's a lot like Tesla, where they're coming up with new products that we didn't even know there was a need for, and they're their growth rate is going up as their products come out. So Jim Cramer says this is like a 10-year stock. You hold it and you just hold it for 10 years and they'll appreciate over that time. But the thing is with chip stocks like NVIDIA, there's pre-orders and there's companies that pre-order. There's ups and downs in the chip cycle where maybe next year, this is why this is so unpredictable. We don't know what the demand is for chips next year or the year after because companies pre-order and then they don't order for a while. And if there's a recession, people don't have that money to invest in these type of items. So Warren Buffett wouldn't own this because it's unpredictable and he doesn't understand technology and he doesn't like investing in technology in general. But this is the industry is cyclical, meaning it goes up and down with the economy, and there's not a whole lot of steady demand. But for me, I'm invested in this. I'm pretty excited about a really big stock that has 360% growth. If it was 360 for these outgoing years, this would be a much more expensive stock. So if they can somehow surprise and come up with more sales for these years, I think even a conservative 50%, growth, it's half off. So we'll see what happens there. It's hard to say because and let's look at some more stocks that Jim Cramer has on his top 10 and why he's holding them. Okay, NVIDIA, he likes the company's founder, the Jensen Huang, the president, and his vision. Let's look at Meta. Meta has a reliable business they have a reliable ad business, and they're trying to go into different areas like metaverse. They didn't do very good in that so far, but they are investing into different AI and if they use AI to make more ad sales for their customers, then that will allow them to grow that ad business more. So the AMD, they're starting to get into AI chips, and we tried to value this a while ago. It's pretty overvalued, so it's not something I would look at. Amazon, they're probably one of the only big 7 stocks that are actually still growing, like 30 or 40%, and their earnings for their sales, the retail sales was really good, like 30%. So I think they're still growing at 30%. We're going to look at Salesforce is the next one on this list. Let's look at Salesforce. Let me see, CRM. Okay. Seems like they're growing at a 15% return over time. They're 36% this year, but then 15% for the next couple years. So the PE is 23, and their PEG ratio is 1.5. Because if it's growing, you divide 23 by 15, and that's 1.5. So they're 1.5 times overvalued. I don't understand the product enough to really comment on the business because I don't understand. I understand they're into AI. They're making a product where people could track and make better sales in their businesses, but I guess I can't really comment on it, but it seems like they're overvalued regardless. So let me see. Let's look at more of his top picks. You can see that he's also following some of the stocks that we're following: Google, Apple, Microsoft, and that's the only ones in common, and Meta, and NVIDIA. Those are the ones we're following, Amazon. The other ones, let's look at some of the other ones he has here. Another one is Eli Lilly. One thing I noticed about Eli Lilly is their growth has changed. Their estimates have changed year over year. They're growing 184% between this year and next year. That is pretty amazing. And the theme, and after that, they're growing 43%. So a couple months ago, we were looking at this as a very expensive stock because it was the PE at 48, and it was only growing at like 30% or 20%. But right now it seems like if you kind of add these together, they're growing around 50%, their earnings. So if the forward PE is 48 and they're growing at 50%, the PEG ratio is 1. So if we rely on these numbers, that's a pretty good price for this right now. It's pretty fairly valued. And if the Alzheimer's drug is approved, which it should be like towards the end of this year, these estimates may or may not, they probably will go up. So we'll just watch for that. This is probably the only growth stock that's a drug company that I have in my portfolio right now. Because, having a growth, most of my portfolio is top-heavy tech stocks, the big 7. But this is one of the only ones that I own AbbVie too, but is a diversification from my other tech stocks. We already talked about CRM. Okay, let's look at Apple. This is another one of Jim Cramer's charitable trust stocks. The reason why Jim Cramer likes this is he likes Tim Cook. He likes his vision. He likes about every year, everyone expects there to be a new iPhone, and the iPhone release in September. And there's free advertising with the telephone companies. They give out free phones in order to attract new clients. So there's a good percentage of iPhones sold, premium iPhones, sold to the telecom companies for getting new customers and retaining customers. So the other good thing about Apple is they have 2 billion installed users to sell services to. So the business model for Apple is they have recurring revenue on their services business, and they're trying to continue to add services to make that build the services over time. So they're growing their services like 10 or 15% a year. You can see with these averages, it's not growing very much at all. The earnings are forecasted to grow around 10%, but their PE is 29. So there's a big disconnect. Their PEG ratio is 3. They're 3 times overvalued, but they're going to be consistently growing. I like the fact that they have cash that they can buy out competitions. They can buy services. They can buy a Netflix and charge $20 a month to people. And if you charge $20 a month to 2 billion people, that adds up. So that's the business. That's a part of this business that I like a lot. And every 6 years they come out with a new product that's like a game changer. Like they came out with an iWatch, and then they came out with a new Vision headset this year, and so they're very innovative. I think they'll come out with some more services, things that make that recurring revenue for services greater. All right, let's look at Qualcomm. This is another one of Jim Cramer's best performing stocks. Let's look at this. Where's Qualcomm? Here it is right here. Qualcomm. Okay, Qualcomm's a stock that sells chips. They sell devices for for phones, cell phones. And right now, I can't really get excited about this stock. They're only growing like 8 to 10%. Let's say 8% over the next couple of years. The forward PE is 13. So their PEG ratio is 1.36. There's 1.6 times overvalued. And it's a chip company, so it's cyclical. It means it'll go up and down with the economy, and the demand for chips goes up and down with the economy and pre-orders and times whenever companies don't need. So I don't know, it's very, Warren Buffett wouldn't like a stock like this because it's not as predictable as maybe a Heinz or Kraft or a company that's or Coca-Cola. Okay, we're going to look at some of speaking of Warren Buffett. we're going to look at some of Warren Buffett's top holdings and why he's holding these stocks. Okay, so Apple is his number one holding. It's almost one half of his investment portfolio of stocks. Actually, it's not. It's when you consider all Berkshire Hathaway, they have railroads, they have Geico. It's a small portion of their investment portfolio, but of the stocks that they're invested in, it's half of their stocks. And why is he like that stock? They have durable earnings, services revenue. See. The other thing I didn't mention yet, they have buybacks, and that increases your ownership. So if I bought Apple like 15 years ago, and I owned 0.0001% of the company, at buybacks, now I own 0.002% of the company because the amount of shares that I have, when you decrease the share count, it increases the percentage that you own of the company, and that increases your earnings. So that's one thing that Apple is very aggressive in their buybacks. And one thing that Berkshire Hathaway, Warren Buffett said about Apple, it's a better business than any we own. For someone who's like the best investor that we know, to say this is the best business that he could think of owning, and it's half of his invested portfolio of stocks. That's a very good check for me that this is a quality company that I can buy and hold, and I can still see growth in all the metrics that I come up with in quality. So even though I know it's 3 times overvalued, I'm still holding it because I know if I sell now, I'll have to take a 20% capital gains charge. And on top of that, I got to find something else that's going to grow at 10% consistently. And it's going to be really hard to find. So I'm willing to sit and watch Apple go down 1/3 the price it's at right now, so I can continue to have this the stock go up 10% a year. Okay, so that's the first stock. That's one of 4 in its top holdings. The second one, Bank of America. Why would Warren Buffett like Bank of America? Well, Warren Buffett likes simple. He likes businesses that are simple and they're going to be around in 20 years and that he can understand. And he actually invested a lot in his lifetime in banks. So he knows more about this than most investors because he actually owned a company. He had to turn around, and he got to know really quickly what banks are about. But he got a good deal on a company in 2008. Right now, it doesn't seem like a very, it's not a growth stock. It's more of a stock you buy for a dividend. You can see from the earnings estimates going forward here, I divided these out. It's not very exciting. Negative 6% from this year to next year, 6%, 7%. So you have a 3% dividend. I guess you get it's growing at 6%, and you have a 3% dividend, so you have a 9% total return. It's not very exciting for me because I'd rather invest in stocks that are growing more, and I don't understand. It's really hard to get your mind around banks and how to understand them because it's outside of what we as normal investors can really understand. The same thing with insurance companies. We don't know the risk that they're taking. We can't really dive deep like we need to understand those companies. So I kind of I bought JP Morgan for my portfolio and Wells Fargo, 2 of the biggest ones, and that diversifies me and gives me a dividend, but I don't really understand banks enough to really buy Bank of America. I don't think Warren Buffett would buy Bank of America now if it was a new purchase. That's my guess. Number 3 holding of Warren Buffett is American Express. It's interesting. He bought American Express in the 60s. The interesting thing is it's still growing. It's growing. They only have 2 years from 23 to 24, 25. So it's not as much analyst coverage as the other stocks, which is interesting. It's an older company. But the forward PE is 13. That's a really low amount. It's growing at 12%. So the PEG ratio is 1. It's fairly valued. I love the sector of payments. I mean, I have MasterCard and Visa as two of my top holdings. They have most of the market share in the world. American Express is like really lower. I guess the good thing about American Express, they have wealthy clientele. So people that are wealthier have an American Express card. They charge like a fee that most people don't want to pay. They probably have lower consumer defaults because if you're wealthy, you're not going to default on your credit card. And they have a dividend. But the problem is with this stock, there's a lack of visibility. We can't see out more than 2 years. And if you compare this stock to Visa and MasterCard, there's a big difference in valuations. Visa and MasterCard are almost double the valuation. Let's look just for kicks. Let's look at the PE ratio of MasterCard and Visa. They're probably ranked 20 or 30. Taking this time here. So if you compare this to other, Discover Card is probably the closest to American Express in the business model because both American Express and Discover Card, they have to deal with defaults and people declaring bankruptcy and not paying their bills. Whereas MasterCard and Visa don't take any risk. The banks take the risk. And that's the main difference between the business model of American Express and Visa. So let's look at Visa we see the stock market is kind of sideways today. No commitment one way or the other. Okay, let's look at the statistics for Visa. So its PE ratio is 30. Let's look at the forward PE. Forward PE is 25. Okay, so it's almost double the valuation of American Express. So people are willing to pay double for every a dollar of earnings than American Express probably because Visa has monopoly with MasterCard and they don't take any risk of the end consumer and it's more predictable, their earnings. So they trade for 1.6 times in the PEG ratio, whereas American Express is more 1 times. So that's interesting he would choose that. But from Warren Buffett, he's probably thinking people are still going to need credit cards 20 years from now. And it doesn't seem like PayPal or any of these cryptocurrencies are catching on. So I would put my money towards credit cards being used for the next 20 years. What do you think, Mark? No comment. Okay. Coca-Cola is the next one. Coca-Cola is the 4th largest holding of Berkshire Hathaway. We have a steady grower that's growing on 5 or 6%. That's 5, 6, 7. Let's average that out to 6%. The 4P is 20, so their PEG ratio is 3.3. So they're 3.3 times overvalued. I guess if Warren Buffett's buying and holding this, he's counting on probably a 7 to 8% total return. If you add up the 6% to the dividend, that's like an 8% total return. And I guess this is part of his portfolio he knows that people are going to be drinking Coca-Cola 20 years from now. And on top of that, they're going to be buying up competitors. Like, for instance, they'd buy a coconut water company, and they can actually send that out with their trucks and sell it along with their Coca-Cola. So that's their main way of growing. They would make an energy drink and put it next to their Coca-Cola, and charge more for that. And when they make new products, that's how they grow. But they're only growing at 6%. So, but they're reliable 6%. So if we see this PEG ratio go down to 1, we'll keep track of this. If it ever goes down to 1, like the price of the stock goes down 1/3 of where it's at now, that could be a place where you start looking into it. All right. There's another article that came out that there's a new ETF called the GMO U.S. Quality ETF. The symbol is QLTY. And interesting that the guy that's running this is a hedge fund. I mean, Jeremy Grantham is a very famous investor. He is like, everyone follows him, and they value his picks and what he does with his GMO company. But he actually has a new themed ETF. He already has a mutual fund that's a quality mutual fund, but this one is an ETF. And he explained that it's built on companies that can sustainably deploy capital and high rates of return, with a focus on tech, healthcare, consumer staples. And these companies can do things other competitors can't. They have moats, they have strong balance sheets, and meaning they don't need to borrow money. And these are battleship companies that are going to remain relevant and important going forward. That's exactly what Warren Buffett wants in a stock. He wants a stock to be relevant going forward and constantly changing their product to be in demand over time. So you can see that the stocks that he holds are Microsoft, United Healthcare, Apple, Amazon, Oracle, Google, Eli Lilly, Accenture, Lam Research, and I don't know some of these companies, but some of the stocks. These are some of the stocks that we're following. And why would he think that? Let's look at some of the reasons why he has these. There's moats. He's looking for strong balance sheets. They're going to remain relevant. Okay, so those are and sustainable, deploy capital at high rates of return. So what these words right here mean is there's return on capital, return on equity. So we look for the return. I bet you every one of these stocks has a high ROE, return on equity. Let's look at Microsoft just for fun. MSFT. So we know it has a moat because it has had monopoly in Office and Windows, and that's all it has a monopoly in. But so it can sell services based on those platforms. Let's look at the statistics for Microsoft and see if the return on capital and return on high rates of return. Return on equity, return on assets, 39. This is amazing. This is an example of if you make a Microsoft Office for maybe it costs them $50 to actually put in the work to make a product, and you sell it for $250. That will give you a return on equity of 39. Or if you invest like $1 million into a project, and then you get back $5 million a year for recurring revenue. So that's an example of putting return on equity. So that checks it off in Microsoft. That's what else is it looking for? It's deploying capital. So let's look at they have capital to deploy. Cash flow. Operating cash flow is $94 billion a year. So they have 50 billion that they can invest in AI or whatever they want to invest in. So that's the kind of thing you have to do, whenever you're researching a stock to buy and hold. These are stocks that they have a moat. They can strong balance sheets. Let's look at their strong balance sheets. Total debt is 100 billion. Total cash, 43 billion. So that means they have 43 billion in cash, 40 billion in cash. That's called a strong balance sheet. And so you have to do that with every one of these stocks, and you're going to come up with similar numbers. And what I did was I figured it'd be good to go through some of those. Again, let's look at United Healthcare. This is one of the largest healthcare providers, and we don't use United, we use Cigna here, I think. We use Aetna. But there are only 3 or 4 big healthcare companies in the country. And I looked at the growth rates. So it's growing around 11%. That doesn't go up further than 2025. The forward PE is 19. They're growing at 11%. So the PEG ratio is 1.7. So for a company that's only growing at 11%, let's look at the numbers on that, just for fun. UNH. Let's look at the statistics to see if we see the similar quality company that they're advertising here. Taking so long. Okay. Okay, let's look at the PEG ratio, 1.5. Okay. Let's look at the return on equities, 25. That matches. That's that. Let me see. Deployment of capital. Okay. High rates of return. Okay, that matches that. Let's look at see if they have a good balance sheet. Total debt is 63. Total cash, 44. So they have 20 billion in debt versus a $500 billion market cap. So that's negligible. That's a good balance sheet. And they have 21 billion to spend after all expenses every year. So that matches the strong balance sheets. Okay. So they're battleship companies, remain relevant going forward. So what can United Health do to improve themselves? They could use their new weight loss drugs to improve the health of people. So that's kind of the theme for United Health. They have a dividend of 1.3%. They can also, what else can they do to be more profitable? So it's not obvious to me, other than that, how they could improve their business. So if you're a railroad company, you can make your railroad more efficient by buying more efficient rail cars. I can understand that industry, maybe making them electric or something, solar. And over time, you can make it so that it's more efficient. But healthcare, as the economy grows, you're going to have more workers. And with more workers, you're going to have more people getting healthcare plans. That's how this company can grow. That's the only reason I think the company can grow. It's almost like waste management, how you grow a company with growing economies. Let's look at Google, one of the next ones here. We like looking at Google because it's a very reliable 14 or 15% growing company over time. Right now, they're 1.4 times overvalued. Their PE is 21. They're growing at 15, so that's around 1.4 times overvalued. But if you add up the numbers, there's a lot more visibility. You can see the estimates go out to 2026. So, and this is in a lot of the top 10 holdings that we're following. So that's another good indication that it's a good stock. Okay, so let's look at, okay, I just want to remind you one more time, I said this last week, but it's really important to diversify your holdings when you're buying stocks, and make sure you understand what sectors they're in, because you never know what part of the stock market or investing world is going to go up every year. So far this year, you can see that the best performing sector is telecom telecom and not utilities. Okay, and tech. So tech is up 26%, and telecom, which probably includes Facebook, and couple other companies that are included as communication companies. And information technology is 34. And consumer discretionary is up 26. So you can see that some years they're up, and some years, like last year, they were down 40%. So you have to make sure that when you're buying and selling stocks that you have an equal amount in different sectors. And as you get older, you have to get a little more conservative with your mix of stocks and bonds. So that's a really good thing to go through. Let's look at some more things on Yahoo Finance before we're done here. Okay, so we're looking at look at Yahoo Finance. Yeah, I know why it isn't pulling up correctly. It thinks we're in Singapore. Okay, that's better. All right. All right, so you see we're flat today. A lot of times people don't like to make a lot of, traders don't like to make a lot of commitments before a weekend. We're definitely overbought right now. Everyone in the stock market knows we went through a rally for the Thanksgiving holiday. Everyone knows we're done rallying and we're probably out of steam. There's no commitment. There's no people left to buy. And just when we've exhausted all buyers, that's the time it starts going down. So be ready for a stock market to, go down next. For me, I'm not selling. I'm just watching it. Let me see. So most stocks are like flat today. You see, we have there's a lot of people that they ask questions like, if I have 500,000 in an IRA, and then you try to calculate your Social Security, can I retire? And the answer for all these questions is it depends on how much money you spend in retirement. And it's good for all of us that are probably earning in a higher amount of money to work as much as you can and try to save around 2 million, because that's the number most investors see as necessary for retirement. Let's look at some more articles. Okay, well, I think, okay, so this is what I was talking about for oil. Saudi Arabia may make surprise oil cuts, sending prices soaring for the futures market. So what they're saying is the price right now of oil is $74 a barrel, like we were saying. When it gets lower like that, big producers like Saudi Arabia and OPEC, they decide they're going to cut, and then the price goes back up to $90 a share. And so you just have to understand that it's not fair. They shouldn't be able to do this, but they do. Backwardation is whenever you have the futures showing higher oil prices, even though you have a lower market now. It's kind of a weird part of futures, but we just have to know that if there is oil prices going up in the future, that's not good for the stock market. That's higher costs for every company doing business. So that's leading towards, if there is a production cut, oil prices go up, the stocks very well could go down. So that's like a 1% chance. That's a variable that adds to the stocks going up or down. If the price of oil is $40 a barrel, the stock market will do really good. If the price of oil is $120 a barrel, the stock market will not do good. So it looks like this is the low for price of oil, and it's going to go up to 80 or 90 next. That's kind of what we get from that news split heading. I think I've exceeded my time limit. I hope you had a good time here and have a great rest of your Thanksgiving weekend. I know a lot of people are on vacation this week, and I'll talk to you next time.
Thanks, Greg.
All right. See you next time.
Bye.